Imagine you have a $10,000 bill in your wallet.
Okay.
It's incredibly valuable,
Yeah.
obviously. Just this massive concentration of wealth sitting right there in your pocket.
Right.
But, I mean, it is absolutely entirely useless if you just need to buy a tank of gas. You can't exactly hand that to the cashier and ask for change.
Yeah, they would look at you like you were crazy. It is a fantastic framing for what we're talking about today, though, because when most people think about acquiring physical wealth, they just think about the price tag.
Right, the dollar amount.
Exactly. They don't think about the shape.
And that's exactly what we're getting into today on this deep dive. If you're listening to this, you're a learner, you follow the markets, you know the basics, and you really don't need us to give you some one-level lecture on why fiat currency fluctuates.
No, we're skipping all that today.
Right. But if you're actually ready to make a move, to really buy physical gold, you run into a surprisingly practical, almost architectural question about wealth.
Which is?
Should you buy coins or should you buy bars?
And that choice dictates so much more than just, what it looks like sitting in a safe somewhere. It fundamentally alters the mechanics of your investment.
It really does.
To guide us through this, we're pulling from some incredibly dense, highly specific source material provided by the Gold IRA Company's Bulletin.
Yeah, great resources.
We are looking at their comprehensive guide titled, Should You Go for Gold, Coins, or Bars?, alongside some really strategic insights from their broader analysis, which is called Navigating the Gold IRA Marketplace.
And what gives these sources serious weight is the researcher behind them. This data is backed by Doug Young.
Yes.
He's a financial markets researcher with over 20 years of experience, but notably, he has spent 15 of those years specializing specifically in gold IRAs.
That's a massive amount of highly focused time.
It is. So we aren't just looking at surface-level generic advice here. We are tapping into decades of evaluating how these assets function in really complex retirement structures.
But, before we get into the literal mechanics of the metals, we do need to set a responsible baseline.
Oh, absolutely, the disclaimer.
Right. It is crucial to remember that all the information we're unpacking in this deep dive is strictly for educational purposes.
Always.
We are looking at market mechanics, storage logistics, and historical trends. We are not providing personalized financial advice. You really must always consult with a qualified financial advisor before making any moves with your portfolio.
Definitely. That is the golden rule, pun entirely intended.
I love it.
But here is the hook, though, the thing that really grabbed me when we started looking into this research. Buying gold isn't just about, tracking the spot price on a ticker tape.
No, it's way more physical than that.
Right. The actual physical shape you buy it in fundamentally changes how you store it, how you eventually sell it, and ultimately what it's actually worth to a buyer.
Is the ultimate example of form dictating function in the financial world.
Okay, let's unpack this. We know you, the listener, already understand that gold is a historical safe haven asset.
Right, people flock to it during a crisis.
Exactly. And the sources emphasize that a common recommendation is to allocate around 10% of an investment portfolio to gold.
Yeah, just 10%.
Right. The goal isn't to put everything you own into a vault. It's about balancing risk and stability. I mean, having stocks is like owning a digital promise, right?
Yeah, just numbers on a screen, really.
But physical gold is like having an anchor on a boat.
Yeah.
You can actually touch it when the economic weather gets stormy.
That's a great way to look at it.
But, if it's just about having an anchor, does it really matter what the anchor looks like?
Well, what's fascinating here is that the physical form of the asset entirely dictates its liquidity and its utility.
Okay, how so?
Well, an anchor is totally useless if it's too heavy to throw overboard or if it's too light to hold the ship, right?
Right.
In the gold market, the shape of your investment changes how it behaves in the real world. You can't just say, I own gold. You have to ask, how accessible is the gold I own?
Which brings us to the heavyweight option in the precious metals world, the gold bar.
The big one.
Yeah, it's the classic image, right? When you close your eyes and picture a bank vault, you picture these massive stacks of gold bars.
Like in the movies.
Exactly.
Yeah.
So let's look at the physical realities of these things. According to the research, gold bars are typically rectangular, and they range in size from 1 single ounce all the way up to a massive 1 kilogram bar.
Which is heavy.
Yeah, for context, a 1 kilogram bar weighs about 2.2 pounds. Imagine holding a heavy bag of sugar, but it's worth tens of thousands of dollars.
It's wild to think about.
And the defining characteristic here is purity. They are typically 99.99% pure gold.
And that extreme purity is really key here. Because gold bars are essentially just poured or minted blocks of metal, their primary purpose is simply to contain as much pure gold as efficiently as possible.
Just raw value.
Exactly. And that manufacturing efficiency translates directly to your cost. The sources are very clear on this. Bars generally have lower premiums compared to coins.
Let's pause and actually explain the mechanics of that premium, because I feel like this is where investors get confused. A premium isn't a tax, right?
Correct. A premium is the extra cost added to the literal spot price of the raw gold.
Okay.
When you buy any physical gold, you aren't just paying for the melted metal, you are paying for the manufacturing, the essing or testing, the distribution, and of course, the dealer's markup.
Right. Everyone has to get paid.
Exactly. Because a bar lacks intricate designs and has zero collectible value, it is much easier and cheaper to produce. So the dealer's margin is just thinner.
The source guide explicitly notes, and I quote, "If you prioritize gold purity in your investment, then bars may be a better option."
Yeah, it's the most direct route.
They also point out the logistics of storage. Because they are uniform, rectangular blocks, they're highly stackable. You could fit a massive amount of wealth into a very small space.
Oh, absolutely.
Like $1 million in gold bars could literally fit inside a shoebox. That makes them ideal for long-term investors with significant holdings.
It's incredibly space efficient.
But wait, if bars are pure and they are cheaper over the spot price, why doesn't everyone just buy bars?
Well,
I mean, it sounds like buying wholesale at a warehouse club. You get way more for your money, you stack it in the safe, and you're mathematically ahead. Why would a rational investor buy anything else?
it's a great analogy, but let's take that warehouse club analogy to its logical conclusion. Buying bulk is incredibly efficient right up until you try to use it in a highly specific, everyday situation.
Ah, like needing a single roll of paper towels instead of a pallet.
Exactly. The major flaw for everyday investors when it comes to gold bars is liquidity.
Liquidity meaning how easily and how quickly you can turn that physical metal back into usable cash without taking a massive loss.
Precisely. Let's say you have a minor financial emergency, a pipe bursts, or you need to raise $5,000 quickly.
Okay, pretty common scenario.
Right. If all of your gold allocation is tied up in a single massive 1 kilogram bar, you have a serious logistical problem.
Because I can't just pay the plumber in gold.
Right, and you can't just take a hacksaw, slice off a corner of that heavy bar, and hand it to a dealer to pay for the plumbing. You have to liquidate the entire bar.
Wow. Okay, and selling a 1 kilogram bar is a significant, highly scrutinized transaction, right?
Very much so. You have to find a buyer with that much liquid capital on hand, and they are likely going to run extensive purity tests before handing over that much cash.
So you are entirely trapped by the size of your own asset.
Precisely. You sacrifice agility for efficiency. And that is exactly why the market created the alternative.
The coins.
Yes. Because large bars lack that day-to-day flexibility, we enter the world of the flexible collector gold coins.
Here's where it gets really interesting. Coins completely flip the script on the math we just talked about.
They really do.
Let's look at the physicals. Coins are obviously round, and they're generally much smaller, usually 1 ounce or less.
Right.
But the purity aspect in the research really caught my attention. The source notes that the purity of gold coins can vary anywhere from 90% up to 99.99%.
Yes, that is a huge point of confusion for people.
I have to push back on this. If I'm paying top dollar to invest in gold as a safe haven, why on earth would I want a coin that is only 90% gold? Isn't that just a 10% ripoff?
It sounds counterintuitive, I completely get that, but it actually comes down to the mechanical reality of the metal itself.
Okay, what do you mean?
Pure 99.99% gold is a relatively soft metal. It scratches easily, it dents, it bends.
Right, you can bite it in the old movies.
Exactly. Because coins, historically and practically, are handled, circulated, stacked in tubes, or just moved around more often than a static brick sitting in a vault. Mints intentionally alloy the gold.
Alloy meaning they mix it.
Yes, they mix it with small amounts of harder metals, typically copper or silver, to make the coin durable.
Ah, okay, so it's not that I'm getting less gold.
Right, and this is a crucial mechanical distinction. Take a highly recognized coin with a 90% purity. It still contains exactly 1 troy ounce of pure gold.
It does.
Yes. But because of the added copper and silver, the actual physical weight of the coin on a scale will be slightly more than 1 ounce.
Oh, wow.
You are still getting your full ounce of gold. You are just getting it in a scratch-resistant package.
That makes total sense. And that smaller size directly solves the warehouse club problem we talked about.
Exactly.
The guide highlights that coins are highly liquid and highly versatile. If you have that same $5,000 plumbing emergency, you don't have to liquidate your entire net worth.
No hacksaw required.
Right. You can just take a few one-ounce coins to a reputable dealer, sell exactly what you need to cover the bill, and leave the rest of your investment untouched and growing in your safe.
It's a huge advantage, but you have to remember that supreme flexibility comes at a cost.
The premiums.
Yes, coins carry higher premiums. You are paying a noticeably larger markup over the spot price of the gold compared to a bar.
So if you're listening to this and thinking, why am I paying a mathematical markup just for the privilege of a pretty design in a smaller size? You're not alone. I mean, aren't I mathematically starting my investment at a loss if I pay a high premium? Why would anyone willingly eat that markup?
Well, it is the cost of agility, but it is also driven by three distinct factors: rarity, design, and historical significance.
Okay.
The guide specifically mentions globally recognized coins like the American Eagle and the Canadian Maple Leaf. When you buy these, you aren't just buying a lump of soft metal.
You're buying a brand almost.
Exactly.
Yeah.
You are buying a highly engineered, globally authenticated, recognizable asset. The dealer charges a premium because the mint charged them a premium, and the mint charged a premium because of the high manufacturing costs of striking that intricate design.
That makes sense. And the sources even mention a lifestyle component to this, which is wild to think about for a strictly financial asset.
The hobby aspect.
Yeah. Nobody has a hobby of trading index funds. But the source explicitly notes, gold coins could be a rewarding hobby in addition to your investment if you enjoy attending coin fairs or auctions and networking with like-minded people.
If we connect this to the bigger picture, you start to see that coins are essentially a dual-purpose investment.
Okay, dual purpose how?
Well, yes, they function as a reliable store of value, serving that core anchor purpose of hedging against economic instability, but they simultaneously exist as a historical collectible.
Right.
You are investing in the intrinsic value of the metal, yes, but you are also investing in the market's ongoing desire for that specific item.
The numismatic value,
Yeah.
the collector's value.
Exactly. Many of these coins have a rich heritage passed down through generations. Rare or limited edition coins, or coins with specific historical mint marks, can sometimes fetch prices in the open market that far exceed the actual spot value of the gold they contain.
Wow, really?
Yes, so you might pay a higher premium up front, but you can also recoup a higher premium when you sell, provided the collectible market remains strong.
Let's go back to our earlier analogy then. A gold bar is like a $10,000 bill.
Right.
It is mathematically fantastic for locking away in a vault, because you paid the lowest possible premium to get that raw value. But it's absolutely terrible if you need to make change.
Exactly.
Gold coins, on the other hand, are like a stack of $100 bills. You'd pay a bit more of a premium to acquire them, but you have way more control over how, when, and where you use them.
That perfectly captures the tension. You are always creating raw efficiency for practical flexibility.
So what does this all mean? Now that we deeply understand the heavyweight champion of the bar and the flexible collector aspect of the coin, we need to talk strategy.
We do.
How do you actually make the choice for your own vault?
It requires synthesizing all these mechanical factors against your own personal situation. The sources provide a very clear framework based on specific decision factors,
Like what?
like your time horizon, your budget, and the very real logistics of your storage capabilities.
Let's break those down sequentially.
Yeah.
First, short-term versus long-term goals.
Okay.
If you are playing the long game, looking to preserve a large amount of wealth over several decades, and you have a larger initial budget, bars are generally the better strategic option.
Absolutely.
You pay less in dealer premiums, you get more pure gold per dollar spent, and you maximize the raw weight of your investment.
On the flip side, if you are working with a smaller initial budget, or if you anticipate needing to liquidate parts of your investment in the shorter term for emergencies, coins are the logical choice.
Because of that agility.
Right. That slightly higher premium is simply the insurance price you pay for the agility to sell in smaller increments. And of course, the guide points out that this isn't an either-or scenario.
Oh, you can do both.
Diversifying with both is a completely valid and often recommended strategy. You can anchor the deep foundation of your portfolio with heavy bars and keep a liquid layer of coins on top for everyday flexibility.
That makes a lot of sense. Then there is the physical reality of storage. We touched on this with the shoebox analogy, but it's worth emphasizing because it is a hidden cost.
It really is.
If you buy physical gold, you have to put it somewhere highly secure. You can't just leave it in your sock drawer.
No, please don't do that.
Coins offer flexible storage. You can easily put a few tubes in a safe deposit box at a local bank or a high-quality home safe.
Right.
But because they're around and usually require individual plastic sleeves or specialized coin storage tubes to prevent scratching, they take up significantly more physical volume per ounce of gold.
It is the ultimate game of Tetris.
Yeah.
Bars, because of their uniform rectangular shape, maximize your storage space.
Right, they stack perfectly.
Exactly. If you are paying for space in a private vault, volume matters. A kilo of gold in coins takes up much more expensive vault real estate than a single dense kilo bar.
Whichever route you choose, the market trends and the safety protocols remain exactly the same. The research insists that you must buy from reputable dealers who offer highly transparent pricing, meaning they clearly show you the spot price versus their premium. And they need to provide certification of authenticity.
Absolutely critical.
This isn't an area where you want to hunt for a sketchy bargain from an unverified seller on the internet.
And to really emphasize the weight of this strategic advice, we need to remember where it's coming from. We are relying on the decades of research by Doug Young.
Right.
This is a man who was the financial director at World Freight Services Ltd. For 16 years.
16 years, wow.
Yeah. He's authored over 500 published financial articles. And perhaps most relevant to this specific strategic choice, he has conducted over 80 gold IRA company evaluations since 2011.
And what does an evaluation like that actually mean for the listener?
It means he isn't just looking at the price of gold. When he evaluates a gold IRA company, he's literally tearing apart their fee structures, their storage facility security, and their rules on purity.
Just diving into the weeds.
Completely. Remember how we talked about 90% purity in coins?
Yeah, the alloys.
Well, the IRS has incredibly strict purity rules for what kind of metals can actually be held inside a tax-advantaged IRA. Doug Young has spent 15 years navigating those exact legal and logistical hurdles.
So he knows his stuff.
He knows exactly how these different assets function, fail, or succeed in the real world of retirement and wealth protection.
So what does this all mean? If I'm listening to this right now, I'm sold on the anchor. I decide I am making a move tomorrow.
Okay.
I'm trying to balance my specific budget, and I'm staring at my home safe, trying to figure out the storage logistics.
Okay.
How do I actually take the first step without getting completely paralyzed by analyzing the premiums, the alloy purities, and the spreads?
This raises an important question, and it really brings the entire deep dive back to your personal goals. The very first step is to clearly define what you want this specific physical gold to do for you.
Okay, like what's its job?
Yes. Is this a hedge against inflation? Are you planning to pass this down as a legacy to your children? Or are you just preparing a liquid emergency fund for the next market crash?
Because the goal dictates the shape.
Exactly. Once you know that goal, you monitor the broader market trends, remembering that gold prices historically tend to rise during times of severe economic instability.
Right.
And most importantly, if you are feeling overwhelmed by the mechanics of it all, start small.
Just dip a toe in.
Yes. Work with a reputable dealer, perhaps purchase a single, highly recognized gold coin like a maple leaf or an American eagle. Build your psychological comfort level with the actual process of buying, holding, and storing a physical asset before you go out and make massive structural changes to your entire net worth.
It is all about taking intentional, mechanically informed steps. So, to briefly recap our core takeaways from the gold IRA companies, Bulletin Research Gold Bars give you maximum raw purity, bulk efficiency, and highly stackable storage power for the long haul.
Yes, the warehouse approach.
Right. They are the ultimate cost-effective store of raw wealth if you don't need agility. Gold coins, on the other hand, give you immense liquidity, historical significance, and even a touch of hobbyist joy,
They do.
allowing you to liquidate your wealth in smaller, controlled amounts for the short term.
Both shapes have distinct mechanical advantages, and both successfully fulfill that critical role of adding a tangible safe haven asset to your broader financial strategy.
Now, if you want to explore these strategies further, check out the in-depth reviews or see the actual head-to-head comparisons of reputable dealers that Doug Young and his research team have put together, you need to visit their site.
Highly recommend it.
Go to goldiracompaniescompared.com for a wealth of related information. That's goldiracompaniescompared.com. And of course, we have included a link to this information right in the notes for this deep dive so you can easily find it.
As we wrap up this exploration into physical wealth and the mechanics of the gold market, I want to leave you with a final thought to consider. We discussed how gold has been the ultimate symbol of wealth for centuries, largely because of its sheer physical permanence.
Right, it outlasts everything.
Exactly. But as we increasingly move toward a world of invisible digital assets, cryptocurrencies, and numbers on a glowing screen, you have to wonder, in the next major economic crisis, will the ultimate luxury simply be holding a piece of your wealth that you can actually feel in the palm of your hand?